All right, let's talk Hershey. They just dropped an earnings report that was a huge surprise, and the stock, well, it took off. So we're going to dig into how they pulled it off and, more importantly, what this all means for what's coming next. Let's jump right in. And when I say it took off, I mean it. A 9% jump in a single day. That's the market basically screaming that this wasn't just a fluke, not just a one-off good quarter. No, this is a signal that investors are completely rethinking what Hershey's long-term earning power actually looks like.
So the big question is, how'd they do it? Well, that's exactly what we're here to break down. We're going to unpack those headline numbers, get into the nitty-gritty of their strategy, and then, of course, I'll give you our analyst take on where the stock might be headed from here.
Okay, first things first, let's look at the actual results that caused all this excitement. I mean, the top and bottom line numbers were just, well, they were really, really impressive across the board.
And what's really wild here is just the scale of the beat. I mean, look at this. Revenue came in just shy of $3.1 billion. That's over $100 million more than Wall Street was expecting. But honestly, the real jaw-dropper is on the bottom line. Adjusted earnings per share at $1.71 when the consensus was only $1.40, that's a massive beat. Yeah, this chart really drives it home, doesn't it? We're not talking about beating expectations by a penny or two. A 31-cent beat on adjusted EPS is just huge. It tells you this wasn't just some small incremental win. It's a clear signal that management's grip on profitability is way tighter than the market realized. So, how did they do it?
All right, let's peel back the onion a little bit and get to the why behind these numbers, because that's where the real story is. This quarter was basically management stepping up and saying, hey, we've got this, and really changing the entire conversation to be all about margin recovery. And this quote from some market research notes, it just nails it. The story here is all about earning power recovery. Think about it. Hershey is showing everyone they can handle those crazy high input costs and still pour money back into the business to grow their brands. That is a really tough tightrope to walk, and frankly, they just stuck the landing.
So here's how they did it. Boiled down to the basics. They pushed through a pretty significant 9% price hike. Now, you might think, won't that hurt sales? And yeah, it did a little bit. Volume dropped by 3%, but the math works out. That price increase was so powerful that it more than made up for the dip in volume. That, my friends, is what you call pricing power in action.
But hey, this wasn't just a chocolate story, not at all. A huge growth engine this quarter came from their North America salty snacks portfolio. I'm talking SkinnyPop, Dots pretzels. That whole part of the business was absolutely on fire, growing an incredible 28%.
And this performance really shines a light on their whole strategy. You see, they're using their classic chocolate business as this super stable cash cow, right? It just generates tons of cash. And then they take that strength and use their salty snacks division as the high growth engine. It's a really smart 1-2 punch kind of approach. Okay, so a fantastic quarter for sure. But you know how Wall Street is. It's always about what have you done for me lately and what are you going to do next? So let's shift gears and look at their guidance for the future and how they handle the tough questions from analysts. And this is really the million-dollar question, isn't it? Can they keep it going? After a quarter this good, everyone gets a little nervous. But if you look at their forward-looking guidance, well, management seems to be giving a very confident, yes, we can.
And this is why the market got so excited. This is the good stuff. Take a look at the guidance for 2026. Sales growth of 4 to 5%? That's solid. But the adjusted EPS forecast, between 820 and 852? That implies a 30 to 35% jump from this year. It's a huge leap. And when you pair that with getting gross margins back up to around 41%, you're looking at a massive step up in profitability. Now, of course, the analysts didn't just take their word for it, they grilled them on the risks. What about cocoa? Management says their hedging is flexible. What if consumers stop buying because of higher prices? They said, actually, people are handling it better than we planned. What about changes to SNAP benefits? They basically said it's manageable and we've already factored it in. And maybe the most important part, they're not getting these numbers by cutting costs to the bone. They're actually increasing their ad spending by double digits to keep the momentum going.
So, we've looked at the results, the strategy, the guidance, the whole shebang. So what's our final take here at Talk Tickers? Here's our official call on what to watch for.
First up, the results. We think this momentum continues, especially in the first half of the year as they get the full benefit of those price hikes. Second, the stock price. That 9% jump? We think it was totally justified. This was a fundamental re-rating of the company's earning power, not just a one-time thing. We actually think there's still room for it to drift higher. Which brings us to our rating. We're calling this one an outperform.
And as always, just a quick reminder, this is not financial advice.